whether it's in the silver or gold markets or the financial markets that you have your eye on right now?
Well, first of all, the fundamentals behind both gold and silver have not changed one iota.
Hmm.
We're still living in a world of geopolitical uncertainty, a world in which central banks are wanting to increase their gold holding. I think the latest announcement was from Holland, who said they're going to buy some gold. Um, Nations are starting to say we can't rely on having all our reserves in dollars, and they're diversifying, and gold. Well, dealers they just don't know where the price is going to be tomorrow, so they've expanded their margins very significantly in both directions, whether you're a buyer or seller, because you might buy the metal at a certain premium, which is a very high premium, but the price of the underlying can move that much in a day. And recently we've been seeing moves likes of which we haven't seen in years. Daily moves well in excess of 5%. I think silver today is, if I'm not mistaken, I looked earlier, it was up or was down 6%. I'm just
Yeah,
looking at the screen now.
it dropped it dropped pretty hard today.
Yeah, I mean, so the metals have been. We've had days where they've been up 5, 6, 9, even 10% sometimes, and then down as much. So if you're a dealer, what are you going to do? You don't take in stock because the price might plunge, and you don't sell stock because the price might soar. So what do? Either you close your doors or you widen your margins. I think that's what's going on. All the dealers have widened the margins. In fact, I've just agreed to buy some gold myself today. I haven't paid for it. I'm paying for it tomorrow, but we fixed the price, and it's on coins, and the margin is the highest margin I've ever paid on a gold coin. Normally, I'm paying around 150, 125 bucks over. I'm actually it's in Swiss francs, but Swiss francs are worth a bit more than a dollar. This time, I think it's getting on for 350 or 400 bucks over.
Oh, geez, that's a lot.
Yeah. Well, it was in this case. I'm buying a gold coin which I actually wanted, but that is the official bullion price which this gold dealer is selling at. He's not selling it because it's a rare coin. It's not rare. It's just what I
Just
happen to want the actual year. Whenever you have a large movement in anything, you get a series of ups and downs with high volatility, just like we're seeing at the moment. And that has a tendency to trick people into taking the wrong position. So there will be, undoubtedly, an awful lot of people who've gone in at the high point, come out at the low point, then they've seen it turn around going up, they bought in, then suddenly it turns around on a 6 months and goes down. So there will be a lot of people who've been making wrong decision after wrong decision after wrong decision. It's not their fault. It's actually the way the markets work. The
right.
markets kind of see what you're doing and then try and trick you into doing it. Then it does the opposite of what you expected. It's a funny old thing I'm going to tell you how to manage that, because I think that there's an awful lot of people who would like to trade gold. They're afraid of buying it in case it goes down, and if they have some, they're afraid of selling it in case it goes up. But whatever they do, they're probably going to make the wrong decision. So I want to tell people how they can manage this so that they won't make a wrong decision.
Right.
So the answer is, when you're doing something in a volatile market like this, you have to do it very gradually. So if you're minded to increase your gold holdings or your silver holdings, don't go all in saying, I'm going to put all the money I've got into gold now. If you're buying, you take a little bit and put it in, and then the market doesn't actually know what your next move is. If it goes down, great, you can buy a bit more at the lower price. If it goes up, well done, you're a smart cookie because you got in a bit earlier, and now you can buy your next lot. And still, even though you just bought the next lot at a higher price, you're still well below your average price is well below the price you just paid. You're a smart
Right.
cookie either way.
The powerhouse names that have driven market gains for years now face serious tests. When a handful of heavyweight companies soften, the effect ripples through major indexes. Broad market strength has historically been built on leadership that consistently makes new highs. But recent price action shows stalling, failed rallies, and breakdowns beneath long-watched support levels. This shift isn't isolated. It illustrates a wider reassessment of growth prospects as investors rotate toward value, defensive sectors, or cash. The risk is that if leadership weakness persists, broader indices may follow, transforming technical deterioration into a deeper trend change.
Yeah, unfortunately, many people can't manage that because they're very excited by what they feel. Either they're, oh, it's going up, it's going to the moon. They're super excited. They throw everything they got at it, or they're super despondent and they say, oh no, it's going to break down below such and such level. So they sell everything, and then it turns around on 6 months, goes up, and they say, but it looked like it's going down. Why is it going up again?
Yeah, no.
It's
I had a YouTuber, sorry to cut you off. I seen a comment today on my channel, and the guy said his wife's going to divorce him because if it goes down any lower, he's going to start using credit cards to buy silver. So it's just so it's emotional buying, right?
It is, and that's why I say it doesn't matter what you're dealing in. Right now, it's gold and silver for everybody, but deal in small quantities, which gives you a second chance if the price goes against you to get that second slice or third slice. You go in more than once at the price, which might be better or worse, but it doesn't really matter which way it is. You're never going to be the last fool because you won't have paid the highest price if you're buying.
Markets are not just numbers, they reflect collective psychology. Recent spikes in volatility measures and fear gauges demonstrate growing nervousness among traders. Elevated readings in option markets show an increased appetite for protection rather than risk. These sentiment indicators are often contrarian. Extreme fear can signal conditions ripe for short-term relief rallies. Yet when fear is coupled with structural breakdowns, it raises the possibility of deeper corrections. Historical episodes of panic selling in 2008, 2018, and 2020 remind us that emotional extremes tend to precede sharp moves both down and back up.
Is there anything concerning you right now, Clive, whether it's in the silver or gold markets or the financial markets, that you have your eye on right now?
Well, first of all, the fundamentals behind both gold and silver have not changed one iota. We're still living in a world of geopolitical uncertainty, a world in which central banks are wanting to increase their gold holding. I think the latest announcement was from Holland, who said they're going to buy some gold. Nations are starting to say we can't rely on having all our reserves in dollars, and they're diversifying, and gold is the obvious way to diversify because it's nobody's liability. But I think it's not. Obviously, there's also the worry that the debt problems of the world are not being addressed.
Right.
Governments around the world continue to engage in deficit financing. They spend more than they're taking in. Europe is now going to be a bit of a problem because of the defense side. Europe has got to spend a lot more money on defense as part of the NATO agreement. So that means the defense budget across Europe is going to be going up for governments which are already heavily into deficit. And what that means is that the debt will be increasing at a faster rate than GDP. And so why are people buying gold? So historically, people would buy gold and say, well, it's not really if they had any at all, it's just sort of like my little keep pace with inflation asset. But
Right.
I don't think people are looking at inflation anymore. I think they're starting to say, it's not a question of inflation, it's a question of insurance or parachute. If things go badly wrong with the debt or with the currency, I want to have something which, one, I don't need to ask anybody permission to own it.
Right.
I don't have to go down to the bank and say, please, would you give me my money back? I don't have to go to the government and say, can you give me something? I've got something which is my own, and I don't have to ask permission. So if we do get into a chaotic situation, everybody and his brother will want to take that gold or silver off you for sure. Not today, because nobody knows what it is. But if we go to a chaotic situation, everybody will want it. So that's your first thing. But the second thing is people are saying, what if this chaotic situation which we see coming with the debt leads to, let's say, a very serious situation of hyperinflation or capital controls or rations or a bail-in where you're forced to put a certain amount of your assets into government bonds or some sort of exchange controls. There's a lot of scenarios out there, but if you have the gold, it's nobody's liability. It's
Right.
yours. So I think what's going on is people are saying, I'm no longer holding it for the inflation hedge. I'm holding it because I'm front running what I fear is coming.
Hmm.
I fear something bad will happen, and therefore I'm holding the gold, and I don't care what price I pay for it. I'm holding it because something bad could happen. It's kind of like being on the. If you imagine you're on the Titanic, okay, and it struck
Okay.
the iceberg.
Hmm.
You might have been. There might not be enough life jackets on the Titanic, but perhaps you've been trading life jackets and making a bit of money. You bought some, you sold them at a higher price, and as you got closer to the iceberg, you could get a really high price for your life jackets.
Right.
So you sold your only life jacket for a much higher price because the iceberg's looming, and then it hits the iceberg, and now you'd like to, you're saying, well, actually, it doesn't matter. I want to buy it back, and the price is irrelevant.
Right, right. Because you need to save yourself. That's it. It's the chaos point.
And a lot of people say, look, whereas this makes no difference to hitting the iceberg. I need to have I need to have the equivalent of the life jacket or the parachute. If your plane has the engine has just died, you need the parachute. And if there's less parachute, so there are people on the aeroplane.
Right.
There's no price. You don't care that you're paying over the odds for it. You say, I'll have it anyway.
Traditional safe havens like gold and silver have shown mixed behavior in recent months. Long-term trends may still favor precious metals amid macro uncertainty, but short-term price action reflects volatility and indecision. Mining equities, often leveraged to metal prices, have suffered despite broader commodity strength. Technical models suggest potential retracements as market participants reprice risk assets. Silver, in particular, has seen pronounced swings, with some longer-range projections pointing to levels well below recent peaks. These patterns echo past cycles in which metals peaked, retraced, and then consolidated for years before resuming major uptrends.
Well, I don't really see it playing out in that way because a lot of what we consume today is not consumed as a result of scarce manual labor.
Hmm.
It's produced by robots, machines, and computers and so forth. So the labor element, which is a scarce element, is not a big component. And also the raw materials aren't that scarce because we found ways to manage the supply and increase the supply when the demand goes up. So I don't really see, except I don't really see a Weimar type situation in terms of the things we consume. But I do think we are already in the early stages of a Weimar type situation when it comes to rare assets, things that people would like to own, need to own, desire to own, but which are in short supply. That includes equities, it includes property, it includes potentially Bitcoin. Of course, we're at a very low point in Bitcoin at the moment, and it includes gold and silver. Of course, it includes paintings, collectibles, and all kinds of things that people want. Houses by the sea, it doesn't matter, but everybody wants more as they get older. And certainly, as you go into retirement, you're going to want to have a comfortable retirement, go on nice, expensive cruises. Perhaps you're going to want to have a nice nursing home or a pretty nurse to look after you. All of these things cost money, and the amount of money they cost is rising at a much faster pace than the CPI index.
History rarely repeats exactly, but it often rhymes. Previous cycles in both equities and metals show striking parallels to today's conditions. In 2011, precious metals peaked and then entered a prolonged period of consolidation. During the 2008 financial crisis, markets sold off broadly, with risk assets collapsing before stabilizing. These episodes teach us that extended rallies can unwind more slowly and painfully than many expect. Investors who chase parabolic moves without risk management often suffer during the drawdown phase. Historical perspective is vital, not to predict exact outcomes, but to temper expectations and prepare for a range of possibilities.
Yeah, I mean, having said that, we've got a distorted market. If we talk about the stock market, we've got a bunch of stocks at the high end which have got rather high valuations and have created what I would describe as suspect earnings through this tactic of what I would describe as vendor financing. So I'll just describe how that works. If you are, I won't name any companies here, by the way, and it's not investment advice, but if you're a very large company and you've got something to sell
Right.
related to AI, for example, you can then find a company which is also in the AI business and can use your product, but doesn't have any money. So what do? You say, we'll buy shares in your company, so you've got a ton of money,
Hmm.
in exchange for which you agree to spend that money that you get on our microchips.
Right. Okay.
So that's great. The seller of the microchips is now in really good shape. It's got a huge profit. It's got sales. The earnings per share go up. The directors can unload their share options at really fantastic prices. The company which is in the AI world, which is on the receiving end of all this money, is happy as a lark because it was struggling to pay the bills, and
Hmm.
now it's got the money, so they're happy as a lark. But let's step forward 2 or 3 years' time. If the AI company which has received this money to buy the chips isn't actually making a profit yet, those shares aren't going to be worth much. The
Right.
shares which the company invested in. So what the companies who are engaging in vendor financing potentially are doing is swapping future risk, because they're taking on a risk that they won't get paid in the future, which is bad luck for somebody holding their stock in the future, but in exchange for current profits, which is really great for the current shareholders, the current directors.
Hmm.
And of course, we don't know whether this risk will materialize or not. That's another question. But it is said that a lot of these companies on their AI ventures would need to charge more and have a larger number of users to actually become profitable on their AI side. So it is debatable whether they'll get there.
In environments of uncertainty, flexibility becomes invaluable. Rather than clinging to positions regardless of shifting dynamics, proactive risk management allows capital preservation and strategic re-entry. Tools such as ETFs provide liquidity and tactical exposure without the drag of physical holdings. Many investors are adopting rotational approaches, stepping into defensive assets when signals weaken, then re-engaging with growth opportunities when clear uptrends re-emerge. Ultimately, success in turbulent markets is rarely about always being invested. It's about being invested at the right time and protecting capital when conditions deteriorate. This mindset will define performance in the years ahead.